In this video, I'm going to calculate for you a forward-looking market risk premium for use in the capital asset pricing model. Now, the reason we need such a thing is because the capital asset pricing model, as you probably know, gives you on the left-hand side the required return on a stock, and on the right-hand side we have a risk-free rate. There's a beta, and then in the normal version of it, the first version of it, you typically see the beta times the expected return on the market less the risk-free rate. Frequently, however, we rewrite this as beta times a number called the market risk premium, which measures basically the market's investors' aversion to risk. Higher levels of the market risk premium mean that investors are afraid of risk more. Lower levels of the market risk premium means that investors are not very wary of risk. And this market risk premium, apparently, and all evidence suggests that this is true, this market risk premium changes frequently, weekly, monthly, certainly over a long time period. So the problem is, what is this expected market risk premium? And historically, we haven't had a very good measure of this. We have used historical measures, meaning we have taken actual returns on the market and subtracted off the risk-free rate, but this is very unsatisfactory, primarily because nobody really thinks that a historical market return is what people anticipate out into the future. You always see on your investments, past performance is no indication of future performance. Well, that's true. The past performance isn't. And what we really need for the capital asset pricing model is a measure of future performance. And so what we're going to do here is calculate a forward-looking market risk premium to be used in the capital asset pricing model. So a data-driven method to get a number for RPM, the market risk premium that's used in the CAPM. So to start off with, we're going to start with the dividend growth model, and of course this only works for very few stocks, but it's going to turn out it works reasonably well for the market as a whole and for indices. But if you recall, the dividend growth model says that the price of a stock is the present value of all of its expected future dividends, and this can be rewritten if the stock is a constant growth stock as P0 is equal to D1 over R minus G, where D1 is the expected dividend in the future, R is the required return on the stock, and the growth rate G is the long-term expected growth rate in dividends. This, of course, is a bit unsatisfactory for most stocks because most stocks are not in a constant growth formula. It's a little bit hard to calculate this long-term expected growth rate, and it's not even reasonable for many stocks. But if you solve for R, if you pretend like it works and you solve for R, you get a required rate of return consists of two components. One of them is the expected dividend yield, D1 over P0, expected dividends next year divided by the current price, plus a growth rate, a long-run growth rate in dividends. And these are the components that we're going to try to estimate for the market as a whole. Now, as I said just a minute ago, the equation doesn't work very well for individual stocks because these long-run dividend growth rates are difficult to estimate, and as a matter of fact, it's not even true that very many stocks even have a long-run stable growth rate. They might they might either have no dividends now and expected to have dividends out into the future, or maybe they're just growing really slowly or very fast now and will have a long-term growth rate that differs from what the current growth rate is. But even more importantly, this formula ignores the fact that companies pay out quite a bit of cash, roughly about as much as in repurchases as they do in dividends, and this is ignoring entirely stock repurchases. So another way of using something like the dividend growth model to value stocks that includes repurchases is to recognize that the total value of a company according to this dividend growth model type formula is the present value of all of the future dividends and repurchases that this company is expected to pay out into the future. And if we take this equation and rewrite it on a per share basis, that means that the price per share of a stock, and we're going to apply this to the market index as a whole in a couple of minutes, the price of a stock is the present value of the dividends and the repurchases all on a per share basis. and this means that we're going to need a measure of the expected dollars to be spent repurchasing stock over the next year. Now, rewriting this so that we can actually find some data that's helpful for us on the internet, we're going to rewrite that equation on the prior slide as and solve for R as the required rate of return is not just the dividend growth rate, but rather the dividend growth rate, not just the dividend payout rate, not just the dividend yield, but rather the dividend yield multiplied by 1 plus this ratio of repurchases over dividends that actually takes into account how much repurchases are done, and the growth rate in the stock's total payouts. And this measure, repurchases over dividends, is something that we can get a handle on, if not for an individual stock, certainly for the S&P 500. And in recent years, I estimated that this ratio has been about 0.82 for the S&P 500, which means that for every dollar in dividends, the S&P 500 has actually distributed an additional 82 cents in repurchases to shareholders. So dividends substantially underestimate the amount of cash that's distributed to shareholders for the S&P 500 stocks. So this is an equation that we're actually going to estimate is the required return on the market as a whole, or the S&P 500, is going to be 1 plus this ratio, repurchases divided by dividends, multiplied by the S&P 500's expected dividend yield, and then to that we will add the expected growth rate in the S&P 500's future payouts. And we'll get all of this data from the internet. So that would give us 1.82 multiplied by expected dividend yield plus expected growth rate. Now let's go ahead and get the expected dividend yield first. This information is not something that you would just make up necessarily, but we can go to S&P, the standardandpoors.com, and find their analysis, and I'll actually pull this down for you, and download their data. Let's go ahead and go straight to it. Go to S&P standardandpoors.com, click on index earnings, and then download this file, and I've got that right here. And when you download the file that's there, it has, in this case, Howard Silverblatt's one of their analysts, and he has provided as of 2/14/2013. For this, I think he does it monthly, maybe quarterly. In any case, 2/14/2013, he has come up with his estimates, and if we scroll on down here, there's a bunch of information in here. But if we scroll on down here and in this report down to row 77, we'll see that his anticipated dividend yield, based on his research, for the future is that the S&P 500 will yield 2.17%. So we don't have to form this expectation ourselves. We can actually do the calculation, and we can actually use Howard Silverblatt's calculations there. And so that gives us 2.17% as an expected future dividend yield. Now we also need a sales growth rate, and this is a little more difficult to come up with. What we'd like is a stable long-term expected growth rate for sales, or at least for total payouts, for the S&P 500, and frankly that's just not available exactly the way it is. You can find one-year projections, and you can even find 5-year expected growth rates both in sales and in earnings, but what we really need is a long-run stable rate that doesn't bounce around a lot due to short-term market fluctuations. We'd like to have something that really does reflect what ought to happen out over the next 5, 10, or 20 years. And one way of doing that is to take the expected inflation rate and add to that an expected rate of increase in real gross domestic product. Now, why would we not just use nominal GDP? And the reason is because the rate of increase in nominal GDP fluctuates pretty heavily based on inflation rates, and real GDP seems to be a good deal more stable. So if we can get some expectation of real GDP increase and then some expectation of inflation, and that expectation of inflation may very well change from month to month, add those together, then we can get a pretty good estimate of the expected future increase in either nominal GDP or just sales as a whole for the market as a whole. Now we can get this GDP information from the St. Louis Fed, and you can actually go to this URL and download it directly. I've got it for you already. And that data here this is what's downloaded from the St. Louis Fed, and it has dates and it has the value of real gross domestic product. And what we're going to do is drop this all the way back to, we'll go back to 2000. So we'll go from 2000 up until today, and we're going to calculate a growth rate. Well, the first thing we'd like to do is we want to do this growth rate, we want to make it an annual growth rate. So I'm going to insert a column, and I'm going to create a new date that is not a regular old Excel date. This date, 200101, if you look at it, you say, well, okay, that's 200101. What it really is what's called an Excel serial date, and the number inside of it is basically a number of days. And if we calculate growth rates here, we're going to end up with a daily growth rate. So what I'd like to do is create a base year, which is a year out of this. And so I'm just going to take this number and divide by 365. And I'm going to turn it into just a number. So I divided it by 365. I turned it into a number. That's 100 years. Well, that's 100.07 years since the Excel dates started, which are January 1st, 1900, I believe. And so now we have years. And I'm going to use Excel's exponential growth charting function to calculate the growth rate in GDP. This is real GDP over time, and it will be it'll be an exponential annual growth rate. The way I'm going to do this is by inserting a chart. So we're going to insert. We're going to use a scatter plot, and this will be a scatter plot with dates, basically 100, which is year 2000, up to today. So we have real GDP. Notice it increased, then we had the recession, and it decreased, and then it increased again. And we're going to find an exponential line of best fit that fits this data. And the way we do that, I'll right click, and well, I go to chart. I click on the chart, go to Chart Tools, and I'm going to select, if you look over here under Chart Layouts, I'm going to select a chart layout that has an equation here, and it has a line of best fit. I'm going to have to change the type of equation in a second. But we have right now a linear equation. Now I'm going to go ahead and right click, and I'm going to, let's see, what am I going to do? I'm going to right click on the trend line, Format Trend Line, and I want to turn this into an exponential trend line. And when I do that, and let's go ahead and move the equation over here so that you can see it. When I do that, we have Y, which is real GDP, is equal to a big number, 2,348, times e to the 0.0157. That 0.0157 is the historical growth rate in real GDP over the last 10 years. And that's probably a pretty good estimate of what the growth rate in GDP is going to be over the next 5 or 10 or 20 years. It's historically been, at least in the last 10 or 20 years, been numbers pretty close to that. So that's a good estimate of what future growth rate might be. Now, just so that you can see it, there's actually an easier way to do this calculation, and let me show you how to do that. Let's see, the chart's not too far out of the way. Another way to do this calculation without having to insert the chart is to use a function called logest, equal logest, and it does a linear regression the same way. You're going to take a bunch of y's, those will be GDPs, so highlight the GDPs down to now, put in a comma, and then highlight the years, those would be the x's, put in a right parentheses and press enter or return. And now unfortunately logest doesn't exactly return what you want. It returns e to the whatever it is you want, so you have to take the natural log of the output from logest, and this number, the natural log, and I'll click on this here, there's logest. And now here we take the natural log of it. The natural log of that number, 0.0157 is actually the same number that shows up when you chart it and calculate the growth rate as well, 0.0157. So there's two different ways to calculate a growth rate using Excel. In any case, it's 1.571% or 1.57% is our good best estimate of the growth rate for real GDP. So if we go back to that, 1.57 as our estimate of the growth rate for real GDP, and there's a picture, there's the graph that we just did, then we need one other thing. So we've got a real growth rate, and now we need a measure of expectation of inflation. All right, so in order to find a measure of expectation of inflation, we'd like a market-determined measure whenever we can, and it turns out that the U.S. Treasury issues a perfectly wonderful security called the TIPS, which is an inflation-adjusted Treasury bond whose yield really does give a measure of the real risk-free rate of return. And if you take the yield on a comparable maturity Treasury and subtract from it the TIPS yield, that gives you a measure of inflation. So that's what we're going to do, is we're going to look at a Treasury yield, and then we're going to look at a TIPS yield. We're going to subtract the TIPS yield from the Treasury yield for a long-term bond, and that will be a measure of our expected inflation over the next 30 years. And this is a market-determined measure. So let's go ahead and look and see where that information comes from. You can get this out of the Wall Street Journal, and let's just go ahead and look and see what it looks like on the Wall Street Journal. If you go to the Treasury Quotes, and in this case we did it on Friday, February 15th, you go to the market data section and pull out the Treasury notes, and we go down to the bottom. Because we want long-term rates, we notice that the long-term yield for the longest term Treasury bonds is about 2.180%. 3.180%. So that's the nominal rate of return on a long-term, a 30-year Treasury. So that's our risk-free rate, 3.180%. And notice over here, we've got 30-year Treasury bonds have a yield of 3.180%. Now we also want a yield on the TIPS, and so let's go ahead and pull that off of the Wall Street Journal as well. And if we go to the Wall Street Journal page, and same thing, Market Data Center, and now pull up Treasury Inflation Protected Securities, scroll down to the bottom, and we see that the longest maturity Treasury Inflation Protected Security has a yield of 0.588%. 0.588% is the yield on a long-term TIPS, and what we'll do is we'll use that as our 0.59%. I just rounded, and so 3.18% minus the TIPS yield, 0.59%, gives us a measure of expected inflation over the next 30 years, a market-determined measure of 2.59%. So we have inflation of 2.59%. We've got expected, if we expect the future growth rate in GDP to be similar to historical growth rate in GDP, so 1.57% growth rate, 2.59% inflation, for a total of 4.16% expected growth rate in GDP, which ought to be pretty close to the expected growth rate in the market portfolio, sales, cash flows, dividends, total payouts, all of the above. So this 4.16 is our estimate of G. So the required return on the market ought to be 1 plus that repurchases divided by dividends ratio, the 1.082, multiplied by the dividend yield, which was the expected future dividend yield is 2.17%. Add to that the expected growth rate. That gives us an expected return on the market of 9.93%. We subtract that Treasury bond yield, the risk-free rate, the long-term risk-free rate from that, of 3.18%, and that gives us a market risk premium of 6.75% as of the middle of February 2013, based on market-determined information. So this is a very valuable little calculation here, and this will change on a day-to-day, week-to-week, month-to-month basis, because Interest rates will change, risk-free rates will change. These estimates that S&P provides on the dividend yield, those will change quarter to quarter. So it gives you a reasonably accurate, up-to-date estimate of this market risk premium that you can use in the capital asset pricing model. Let me scroll all the way back to that first slide. The market risk premium right here in the capital asset pricing model. So if you were using CAPM for an individual stock, you would take the risk-free rate, say the Treasury bill rate, plus the beta that you estimate for the stock multiplied by that 6.75% to get the required return on the stock.